explain you that how exactly we can understand the concept of in the money, at the money, and out of the money. So guys, first look at this underlying price. So last trading session, the Nifty index closed at 11,930. And if you look at the option chain, however, we'll discuss it in a detail, but just let me give you some concept of in the money, at the money, and out of the money. So first check the price of underlying 11,930. So on the right side we have puts, on the left side we have call, and in the middle we have strike price. And if you look here, the strike is starting from 9,300 with an interval of 50, and it goes till the end of 13,450 strike. So we are having the interval of the 50 and strike starting from 9,300 and goes till 13,450. Now if you look here, at the top of the boxes we have right side we have puts, on the left side we have call, in the middle we have strike price, and then bid quantity, bid price, ask quantity, ask price, net change, last trading price, implied volatility, volumes, change in open interest, and open interest. So this is for put side, and similarly there will be same kind of column for the call side. Now you need to understand that what is the market. So market is near to 11,930, so that is in between 11,900 to 11,950. So when underlying remains in between your strike price, you can give the benefit to the nearby strikes. So if that is 11,930, you can consider 11,900 as at the money, or you can consider 11,950 as at the money. But as per the theory, you should consider more to 11,900 or 950, whatever suits to you. But if you are looking at 11,900 call and the index is trading at 11,930, so 900 call also will be having 30 rupees as an intrinsic value. So now I'm looking at the premium. So we have calls and puts. You need to understand, if one strike is in the money for calls, that will be out of the money for the put. But at the money always remains same whether you are talking about calls or puts. So 11,900 is the strike. Right now market is at 11,930. I'm looking at 11,800 strike. So if you look at the 11,800 strike, the premium is 185.90. So I'm taking the premium 185 and I'm looking at the strike of 11,800. So first I need to know what is the intrinsic value. So underlying price is 11,930 and your strike price is, I'm just opening the Excels to just give you the brief about how exactly we can do the calculations. So if you look here, if you look at the concept here on the, so your underlying price is 11,930. Your underlying price is 11,930. This is your spot price, you can say. Your spot price or underlying price is 11,930. Your strike is 11,800. So as per the concept of formula of intrinsic value, you need to know that for the call it is spot price minus, this is your spot price minus the strike price. So that is 130. So this 130 will be intrinsic value. So now you need to understand what is the total premium. And if you look at this NSE India side, your total premium is 185.90 for 11,800 call. I'm taking as 185. So your 11,800 call is trading at 185. 130 is your intrinsic value. Now you need to know about the time value. So how to get it? To get the time value, you need to remove the strike, the premium of the particular in the money strike minus the intrinsic value. So that is your time value. So if the spot is trading at 11,930 and you are buying 11,800 call, which is trading at 185, your 130 will be intrinsic value and 55 rupees will be your time value. Now again I'm looking at the different strikes. Now let's say 11,600 call. So 11,600 call is trading at 354. So now again I'm repeating the same. The 11,930 is your spot. You are looking at 11,000. You are looking at the strikes of 11,600. So 11,600 is your strike price, and the premium, as you seen here, that is 354. So you mentioned 354. Now what do you need? First you need the intrinsic value. How to get? You have to reduce the spot price minus the strike price. So that is 330. So 330 is the intrinsic value for 11,600 strike call, which is trading at 354 rupees. Now how much is the time value? You reduce the intrinsic value out of the total premium. That will be your time value. So in 11,800 call, which is trading at 185, 130 is the intrinsic value and 55 rupees are the time value. For 11,600 call, which is trading at 354, 330 is your intrinsic value and 24 rupees will be your time value. So according to the same, now if I'm going with at the money call, let's say 11,950. 11,950 call is trading at 91.85. So if I look at the 11,950 call, so if the spot price is same 11,930 and my underlying price is 11,950, premium of that 11,950 call is again need to see here 91.85. 185. We are talking about the call side, that is 91.85. And if I'm just putting the 91.85, if you ask me what is intrinsic value, zero intrinsic value, entire value is all about the time value. So this was the in the money options. This was the in the money option. This is at the money, or you can say out of the money options, slightly out of the money options. And that is why there is no intrinsic value, zero intrinsic value, and entire the value is all about the time value. So what is the real concept of intrinsic value is, if let's say market settles today, this 11,800 call will be having the premium of 130, because towards the expiry there is no time value, there is only intrinsic value. Similarly, if market settles right now and it's the same scenario, 11,600 call will be having the premium of 330, because market settles at 11,930, you have bought 11,600 call, so obviously the in the money intrinsic value will be 330. So that is the last premium for any for this contract of 11,600 call on the expiry day. Similarly, on 11,950 strike, there is no intrinsic value. So if market settles today at 11,930, and let's believe today is the expiry, there is no value will be in the options. The closing price of this option will be 0.05. So this is how one can look at the same. Now I'm taking one or two examples from the put side. So I'm taking the example of put side. This was the example for the call side. I'm now taking the example of the put side. So let's say the put. First, I need to know about the spot price. So I'm just copying the same things. Spot price. So spot price, we are very clear. 11,930 is the spot price. We are talking about the put. So we can take any strike. Let's say we are talking about the 12,000 call. So 12,000 call is trading at 133. 12,000 call is trading at 133. So what is the strike? 12,000 call. What is the premium? 133. So 12,000 call is 70 points in the money. 12,000 minus 11,930. You must be knowing that for intrinsic value for the call, the formula was spot price minus the strike price. But for put side, the formula is all about your strike price minus the spot price to know about the intrinsic value in the put side. So intrinsic value is 70 rupees, but total value is 33. Rest will be your time value. So time value is all about this premium minus the intrinsic value. The rest amount will be time value. So basic. So as per this concept, if you notice on the call side, more you go to the lower strike. Now let's say we discuss about 11,900 call. The premium is 118. So your 11,850 premium is 50 rupees higher, because that is 50 rupees more in the money. So premium is 150. Your 11,800 call is near to 186. Your 11,750 call is 223. Your 11,650 call is, you can see, 312. So more you go on the lower strike on the call, higher will be the premium because of the intrinsic value. But more you go to the out of the money strikes, lesser will be the premium, because that is all about the time value. As you go to us deep out of the money, the premium will be lower because of the less time value. So look at the 11,950 call 91, 12,000 call 68, 12,050 call 49, 12,100 call is 34. So as you move to the higher strike in the call, lesser will be the option premium, because that is all about only time value. There is no intrinsic value in that particular strike. Similarly, if you look at the put side, and let's say market is 11,930, more you go to the higher strike, let's say 11,950, the premium is 105, 12,133, 12,050, 163. As you go more to the upper strike in the put, that will be more in the money, premium will be higher. But as you go lower to lower strike, let's say 11,600, only 17 rupees is the premium, 11,500, only 12 rupees is the premium. So now if you compare your calls and puts of the different strikes, in the money options for the call will be out of the money option for the put, and out of the money options for call will be in the money options for the put, but at the money remains same for calls and puts. So this is how we can understand about the intrinsic value and time value of the different strikes based on the change in the spot price, based on the current spot price. Again, going to the PPT, we discuss about an example that particular strike is 20 rupees, but underlying spot price is 24. So that is 4 rupees in the money. So intrinsic value will be 4 rupees, and the rest part will be time value. So the option of this 20 rupees strike is 7 rupees. So 4 rupees is the intrinsic value, 3 rupees will be time value. Now, how option pricing change over the time? This is very important concept to understand. See, at the initial period, the time value highs. You must have noticed at the beginning of the expiry, your premium always remains high because higher the time value. Intrinsic value is same whether you are talking about at the beginning of the start series or towards the end of the series. It depends on totally the change in the spot price and the strike price, whether you are looking for the calls and puts. So initial period, your time value remains high. Your option is in the money, price will be high. Your option is at the money, price will be comparatively lower. Your option is out of the money, price will be much lower. And as you more go to out of the money or deep beta out of the money, your core option will be lower. Similarly for options also. So in the money premium always remain higher because of the intrinsic value. At the money premium comparatively lower. More you go out of the money, whether you're talking about the calls and puts, premium keeps on reducing because more out of the money put or call means lesser the chances of that strike to be in the money towards the expiry. If option goes out of the money or stays at the money, option price starts falling. That you need to understand. An expiration date near time value falls and option premium falls. So if you ask the options buyer what they want market time to move slowly because the biggest threat for the options buyer is the time decay. As the day passes, the premium declines. And biggest advantage for option writers, if you ask any option writers, what is your wish in the life? Their wish is they want the expiry to settle before it starts. Because options writers are playing for the time decay. Options buyers are playing the time value, but playing for the volatility and the momentum into the underlying assets. But options writers are only looking for the time decay or the inverse movement in the market compared to this type of options which they have taken. So this is a nice concept about the options pricing. We discuss about intrinsic value, we discuss about the time value, what is the role of the intrinsic value and the time value, and then in the money, at the money, out of the money, and the different scenario for calls and puts. And time value always keeps on changing as the time passes. Bigger the time for expiry, higher will be the option premium. And as we go towards the options expiry, the time value falls towards the zero. But intrinsic value remains higher. More you go in the money, whether you are talking about the call side or the put side of the options. So that is the nice concept about the options pricing. Thank you friends. Thanks for watching. Nice learning. Have a great time.
Download our app today. Link in description.